Hello and welcome to another edition of CryptoKoryo podcast. In today's edition, I'm very happy to have Mehdi Lebbar, co-founder of Exponential.fi. Hello, Mehdi. How are you doing today?
Hi, Koryo. Thanks for having me.
Great to have you. Thanks for being here. Today we are changing gears a bit compared to our last episode, and we are talking about yields. It's a sector which is, one of the most of the biggest sectors in DeFi in terms of TVL are related to yield. So very happy to cover this sector with you and to talk about Exponential.fi. But let's start with you. Can you tell us about your background, how you came to DeFi, and what led you to Exponential.fi?
Yeah, so I have a background in finance. I started my career in investment banking in London. I was part of the team at Credit Suisse in M&A, and I also had the chance to invest in sub-Saharan Africa with the World Bank, which was like a frontier market. And so I have basically a very fundamental approach to finance and to risk that I was able to apply then to crypto and DeFi. And so that's basically my background. Like the majority of my team, I also spend a lot of time with Uber, and I launched Uber Eats in London. I also was part of the team of Cloud Kitchen that Travis Kalanick built out of LA. Yeah, that's basically the tech startup side of my life.
So a lot of entrepreneurial experiences prior to coming to Exponential.fi. So let's talk about the yield sector. In 2020 and 2021, that's where we had the DeFi summer, probably for the first time, because prior to that we just had some blockchains and it was mainly infrastructure. And for the first time, we started to have some real DeFi protocols like Uniswap, Aave, Maker had their moment in 2020 and 2021. We also saw a lot of like kind of Ponzi schemes, a lot of tokens launching, projects launching, a lot of very unsustainable activity that then led to, once we had the bear market, we saw what happens. So we currently, can you give us an overview of where we started with the yield in DeFi in since 2018, and then where we are now and how things have changed? To start with an
Yes,
overview of the
absolutely.
sector.
So I would say that before 2019, you had only yield in centralized finance in CeFi. So you would be able to get yield on crypto with BlockFi, Celsius, Voyager, Nexo, all these companies that would
Non-existing.
ba- most of them don't exist anymore, and for good reason. And
Yes.
so I was managing a crypto fund at the time for family and friends, and we had a passive investing strategy. And so we really were interested in getting some yield on our crypto. And we only had BlockFi, and it was great because it was super easy to access. You just KYC, you create an account, you put your money. The issue was you don't have transparency. You don't know how is the yield generated, and how do you make money there. So we were not actually doing it. We didn't feel comfortable with that. But when DeFi happened, you had the opposite problem. You had all the transparency of the world. You can look at the blockchain, you can look at the smart contract, you can understand where the yield comes from, all the flow of the money. But it was really hard to do it. You had to know the flow, move across chains, sign contracts in a blind way with your crypto wallet. Once you did that, you had a position, you had to assess risk, you had to think about what's the risk of the contract failing in the trade execution or while you're earning the yield, and all of this were key pain points. And so today what you have is you still have CFI, which is opaque, and I think you need to be careful with anything related to yield coming from centralized exchanges and things like that. But you also have DeFi, which is wonderful but hard to access, and that's where we come in. We make DeFi more accessible.
Absolutely. So, especially I think in the earlier days, in 2019, 2020, because everything was new, there wasn't a lot of neither infrastructure nor analytical tools or anything, or even wallets were in their early days, So it was
Yeah.
everything was very rudimentary. And it wasn't very user friendly. Still, there is, a lot of work being done on that front. So, that was when Exponential.fi came. Now, let's talk about current state of the yield. We have different sectors, I believe. Currently, we have staking from Ethereum, becoming a validator, or going through LSDs that provides real yield, as we call it. We have now more recently restaking with protocols like Eigenlayer and LRTs like EtherFi, Kelp. We have lending protocols like Aave, where you can deposit some money and just get some yield. You can become a liquidity provider on dexes and perpetual dexes like Uniswap, GMX. What else do we have? Like, where currently today in DeFi, where is the yield coming from? Question number one. Question number two, what kind of trends are you seeing and flows between these different yields?
Yeah, thank you for this question. So I invite everyone to actually look at the state of DeFi report that we have published just a week ago, and that looks into like where the yield comes from and so on. So it's a very interesting report that, because we have a perspective about all of this. Like, we look into the yield in DeFi across like 500 pools. We cover 90% of the opportunities out there in terms of protocols and chains and TVL. And so we have a very good understanding there. So the way that we look into DeFi, we look at it into jobs that are being done thanks to the capital, the liquidity that you are providing as an investor. So you provide liquidity to stakers, for example, or staking in order to validate transactions on chain. That's the first job, and that's the main job. That's where most of the yield comes from. About 70% of the yield is coming from there. The second job that appeared was actually lending. And lending is very interesting in DeFi because it's secured lending. It's over collateralized lending most of the time. I mean, that's the way it needs to be over collateralized so that it can work in DeFi, because DeFi is trustless, permissionless. Basically, it's like something where you don't have to trust the counterparty. So in order not to trust the counterparty, you need the counterparty to actually put a collateral that is like significant for that. So secured lending is probably making about 20% of like the yield today. Uh, the yield that we talk about the most is actually market making for dexes, so liquidity providing for dexes. So what the job that your capital is doing there is very simple. It's like you are the guy at the airport, outside the airport, who has euros and dollars and who can make the currency exchange for you. And so what's happening there is like you come to the guy, he has euros and dollars aside, and he's ready to make the exchange at any time for you. And so he gives you a price up and down for euro and dollars. And so who you are on the other side, you have to own like 50-50 euro and dollars, and your financial asset is basically the pool of these two. And it increases with more euros when the euro goes down and people are like arbitraging you. And so it's a very interesting new financial product in the world to provide liquidity on DEXs.
So you're
And
probably
the fourth one that we see,
talking more specifically about
yeah,
AMMs and the constant product that Uniswap, etc., initially used on their version two.
yes. And so if you wrap it into like what it is, and when you invest, you basically invest in a portfolio of two assets or more that are basically you have a little bit of both, and it also constantly rebalances itself based on the price of these two, so that the two assets stay 50-50, for example.
Let me ask you a follow-up question since you recently released this State of DeFi report. First of all, what kind of profiles are you seeing from people who are looking into yields? Are there more institutions? In general, our perception in from crypto Twitter is that the degens are not the ones that are looking for yields. They're mostly into trading. The ones that are into yield, maybe the ones that have higher capital, maybe institutions who have lower risk appetite. What kind of trends are you seeing in terms of the users of the yield, and how these do you see any change in the cohorts recently or anything?
So we looked into the data, and a lot of things were interesting. The first thing that was interesting is that people were more risk averse than we thought. So 85% of like the TVL, or the assets invested, are invested in highly secure, battle tested protocols that are low risk. And so that's something that's actually pretty good. The other thing that is interesting is in terms of cohorts. So we see three big types of investors. You have the institutionals, you have the retail, and in between the two, you have the whales in a sense. So which are like basically high net worth individuals of crypto. And like while 95% of people are from retail that interact with these contracts, they actually represent only 10% of the TVL. You have like a very large
Interesting.
part of the TVL that is currently like taken by high net worth individuals and whales who are actually doing the core of the investment in DeFi. And you have a little bit, although like significant, around 10 to 20% that is being taken by hedge funds and institutionals who actually like do all the risk parameters and like calculations to make good use of this yield. Our objective is to make it easy for retail to actually understand this product and be able to invest and get yield on their crypto in a fair way.
That's very interesting. That's also something that looking into on-chain data, I saw while analyzing airdrops is that most of the users get actually very little, and but they represent maybe 95% of all users who got an airdrop, and I think it's a very similar pattern. And the 5% that get the most of the airdrop, these are usually those who provide liquidity into the protocol. So we see really a very small number of users who are putting and providing most of the liquidity, and also the majority putting very little. So you mentioned about institutions. Let me ask you a question about the adoption of institutions, and specifically ETF, the Bitcoin ETF. Do you think that first, are you already seeing some kind of changes in the behavior of institutions after post ETF? And what kind of trends are you seeing from
Yeah,
institutions?
I think so. From institutions, what we're seeing is that it is a slow train. Uh, they are definitely adding crypto as an asset class to their portfolio. It's not a question of whether it's going to happen or if it's going to happen. It's just when. Um, every financial institution has to take risk into perspective and has to understand this new asset class, which is crypto. The Bitcoin ETFs is opening that opportunity for all of them. And over the next few quarters, every asset manager has to ask the question whether they are going to allocate to Bitcoin or not, because now it is available. Before then, it was like, oh, it's too complicated. Nobody is doing it. Today, everybody is potentially able to do it. And so that's something that's definitely happening. I think it's going to also take a lot of time. Asset managers are like don't have the incentive to add Bitcoin. It's going to happen by a sort of FOMO, a sort of like where other people are going to make money and they are not going to be making money for their clients and for themselves, and that will lead them to allocate more and more to Bitcoin. So the more Bitcoin goes up, the more investors we will have, and that's the reflexivity of crypto, which creates a lot of problems as well in terms of volatility. But that's a little wonder as well of finance.
Yes, it's interesting to see that even institutions have this FOMO thing. And if you look at the investments in crypto, and if you look at, the adoption of institutions, it's usually comes in the bull market, and when the prices are already up
Yes.
quite a lot. This morning, I was looking in some of the yield protocols, more specifically Pendle, and they already have bunch of pools, like dozens of them, that have plus 50% APY. Especially recently, with restaking and new protocols like Ethena, etc. Um, is this sustainable? One, two, is this comparable to kind of the similar numbers that we had in 2021, or now is it a new paradigm? Is it now based on something
No,
real? And how
there's no new
long?
paradigm.
Yeah.
This is not sustainable.
Okay.
When you get a yield above 50%, it's generally that there is like something that's off there. Normally, every yield is going to be pushed by the theory of efficiency of markets, is going to be pushed down by providing, basically, people are going to continue providing liquidity until the yield goes down. And so when you see 50% yield that stays there for a long time, there are question marks about the risk. The reality is today there are two big things that are like scary in DeFi. DeFi is somewhere where we can innovate in finance today. We can like create new things. But the two big parts where we have innovation and risk at the same time are restaking and algorithmic stablecoins. In terms of restaking, the issue that we have there is an amazing idea first. Like it's a great innovation where you basically like you can have yield on your crypto with staking, and well, you get a receipt for that for that crypto generating yield, and you want to have more yield on that receipt. So it's like compounding the yield, but it's also compounding the risk. The issue we have with restaking today is
Hmm.
we do not know yet what is the job that is being restaked. So as long as you don't know what is happening in the background, you're basically in the same position as investing with BlockFi. You have to trust the team to do the right thing. And if you do have to trust the team to do the right thing and you cannot check what they're doing, then you are in a position where it's not very good for you. It's a position of asymmetry of risk where you don't know the risk, they know the risk, and they're using your money to cover for that. So what we're looking for in restaking is more transparency, and that's going to happen because this is DeFi. It's probably going to happen where we are going to start to be able to follow the flow of funds. Right now, restaking is not being used, so we cannot. People are just getting points, and so we will look into it. We will look into how do we get the compounding of yield, and we will look into how what's the compounding of risk that comes with it. For algorithmic stablecoins, it's very simple. Ethena and so on. It's the same questions that happen with on in terms of like risk reflexivity. In terms of like when you look into an algorithmic stablecoin, it's actually super hard to do that. And so how do you sustain that is very complicated because you basically end up having to create a lot of liquidity with not enough collateral. And so there is always a risk for a run on the bank. And if George Soros can bring the Bank of England down, I think that there are a lot of other people who can, the whole market can bring any algorithmic stablecoin down. And so while we don't see any immediate risk for Ethena, I think there is like a fundamental risk there around algorithmic stablecoins.
We will talk more specifically about Exponential.fi later, but does this mean that at this point, Exponential.fi does not provide any yield pools or solutions on restaking and on
That's
algorithmic
right. We do
stablecoins?
not. So we do not also
Okay.
do concentrated liquidity, for example, on market making. What our philosophy, and it was the philosophy when we launched Uber Eats in London, for example, is like whatever you take on the app of Uber Eats in first year, you would love what you eat. You would love it. And so we have the same strategy here, where like whatever you invest in on Exponential, you should be happy with it. And so when we look at concentrated liquidity, there are a lot of cases where you see that the yield doesn't make sense. When we look at restaking today, well, we don't know what's the risk, so we assess it as like very high and we don't offer it. And the same thing with algorithmic stablecoins. So there are parts of DeFi that when you do the research, you realize that it's not worth it, and that's why we do the research.
Amazing. So just before delving into the specifics of Exponential.fi, the yield in DeFi usually fluctuates for every protocol. There is at any given time, you see a number, and then hours or days later is something else. Besides market and demand and supply, what are the more nuanced parameters that affect this, and especially how do protocols set these numbers? Because I believe sometimes is protocols who manipulate these
Yes.
numbers.
So at Exponential, we actually check the yield as from what it is. We verify the yield, so we invest in the protocol, and then we see what the yield comes out of it. So that's something that is important. So the yield on Exponential is actually verified yield, which is amazing. Um,
So you do not trust the number that is provided by the protocols, or
we do not trust it. We do not. We
right?
verify it. You don't trust. You
Mhm.
have to.
Verify, don't trust. Exactly.
So the counterparty to the fact that the yield is variable is the fact that normally you should be able to pull your funds at any time. And so that's a good thing. which means like that the market is happening block by block on the blockchain, minute by minute. If there is activity, it is going to generate yield for you. That yield that is generated is divided across everybody that's providing liquidity, right? And that's block by block for most protocols. That's the way it works. Sometimes protocols also add rewards, and the good thing about that is that very often it's like free tokens in a sense for people who provide liquidity to kickstart the protocol, to allow like liquidity to flow in so that the protocol can do its job while demand is coming. But it's also interesting for protocols because they are decentralizing their tokens. And so we are able at Exponential to capture all that upside for the rewards and give it to you, claim the rewards automatically without you having to pay gas fees. We do it for all our investors. And so the way we look into this is pretty amazing, where you can have yield and get a reward on it.
Amazing. So now let's talk about Exponential.fi. So Exponential.fi is a yield optimizing solution, um, where you look at different yields that exist in DeFi, you assess the risk, and then once they are okay with your risk models, you invest for your users, so that they can just you know it's kind of passive income for them, right? You do the hard job. Can you explain a bit more specifically this task that Exponential.fi is doing?
So Exponential is an investment platform where you can get crypto with yield. And that yield is coming from decentralized finance because that's the best form of yield on crypto that exists. And so basically, instead of buying Bitcoin, you buy Bitcoin with yield on top of it. And that's basically the short story. Um, we make DeFi more accessible by managing all the routes for getting that yield. We look into all the protocols and all the pools, all the chains that are out there. We assess the risk on them. We come up with a risk rating that says this is high risk or low risk. And we verify the yield there. We show you the yield on a daily basis for the past 30 or 90 days. And then like we let you choose in very curated pools. Like we assessed more than 500 pools. We are only make 25 available. And so like uh, that level of like 5% of curation is very strong.
Absolutely. So, what is very specific about Exponential compared to there are other yield, automation, like Yearn Finance and others that are doing these kind of things. But I think what is special about Exponential is this risk assessment and fundamental research. Can you elaborate on your side on the differentiators of Exponential.fi?
Yes, I would also say that we're not a yield optimizer like Yearn. Yearn is actually like a protocol, and so we will use Yearn to provide yield for our investors. The real way, there is no real competitor to Exponential today. We're doing something that does not exist, which is like provide access to DeFi in a way that is like within the regulatory framework of finance. We do the KYC, for example. When you register, sign up, you have to KYC, and that's how like we are basically a centralized party in the middle between you and DeFi. And so that way we make DeFi very much more accessible. You don't have to manage a wallet. You don't have to manage your funds, a seed phrase. We take care of all of that with state of the art safety and security as well.
Absolutely. So let's talk more about that because it's something that is, I think, is important to mention. So one of the key elements of DeFi is decentralization, of course, but also permissionless and this kind of stuff. You decided. I mean, there are others, but you've decided to not have a permissionless protocol and have KYC. So you have custodial platform. This provides a lot of safety benefits for the users because there are a lot of scams in DeFi. There are a lot of risks involved with wallets, hacks, breaches, all these things. You take care of that, but then on the other side, users have to KYC, which some users don't like. Can you elaborate on why? Why did you decide to go on that
Yeah.
route?
So we were like we took the problem from like if you want to make DeFi accessible, you have to make it as accessible as, let's say, crypto is using Coinbase. And so, if you want to build Coinbase, you have to be within the framework of the law. You become a money transmitter. You have to make sure that you're not having securities on your platform, that things make sense in terms of investors for like investor protection. And because we are there for investor protection and we believe in that, we decided to flip it. Instead of like starting with a wallet that takes out like 80 or 85% of potential users as humans, like we can do it probably use a wallet, but when I look at my mother or like when I look at like some friends, they just cannot use a wallet. And so but they are all able to have a Coinbase account or a Fidelity account or like a brokerage account, and they know how to use that. And so our work was to do exactly the same thing, have the simplicity of the UX of an exchange account or a brokerage account, and have the benefits of DeFi. And so we think that this is like a compromise in the sense that we,
Hmm.
by getting that in the same way that you would open a Coinbase account, we make DeFi more accessible. Our philosophically, we think that that's a necessary step to Bitcoin. Just like Coinbase is a necessary step to getting access to crypto and learning about crypto, Exponential is a necessary step in order to be able to get access to DeFi, understand it, and if you want to have your self custody as well afterwards, you can like learn, and you have a good reason to learn because you're actually making money on Exponential. Now you have a good reason to learn about DeFi. Let's learn about it, and if you want to do it on your own, you should do it on your own.
I would say rather than saying it's a necessary, we can say it's a preliminary step, meaning that it's much easier to onboard people. For example, me and many people, other people, when they first started their journey in crypto, the first thing you do is you download that Binance app, that Coinbase app on your phone, and you know nothing about MetaMask and all these things, and because it's much easier, right, for a simple retail user to just not worry about all these custodial and wallet things, which is, I think, one of the possibly one of the ways that we will get mass adoption is by making it simpler. So more specifically, how does it work? I come up to Exponential.fi, I have an email, I sign up, I KYC, then you create a wallet for me, and then I deposit through a credit card, or how does things work?
Yeah. So it's a pretty simple. When you first create an account, and by creating an account, you have to KYC and set up your two-factor authentication in order to secure your account. We create a wallet for you. That's a wallet where you can put USDC or ETH and probably like more Bitcoin soon as well. And you get the chance to invest those funds in any pool that you want. We show you about 25 opportunities in terms of yield investment, and based on like the asset and the yield and the risk, you basically get to choose where you want to invest. If you have ETH, you can like just place it in an ETH pool and just choose basically where you want to stand, and like you can spread it across all the investment opportunities of Ethereum that are out there. And so the amazing part as well is that we have like a wonderful part for performance. Like you get performance analytics that are really really good, where you understand how much yield you generated, and like how much capital gains did you get. And if you're trying to file your taxes in DeFi today with your wallet, it's basically impossible. It's extremely hard. Uh, I
Yes.
went through it like
Yes.
2 years ago, and it was so painful. But with our analytics, because we separate the yield from the capital gain, we have all the analytics very perfectly done in order for you to recognize which lot you actually sold, and it's like a breeze. You give that to your CPA, they will be happy.
Amazing. Yeah, that's one of the things that at the end of the year, everybody's worried about, like, what should I do with my crypto taxes? How does it work?
Yeah.
And especially there is not a lot of tools that allow you to do that in a simple way. So it's definitely a problem here. Um, One of the big things about Exponential is the risk assessment models. Let's talk about a bit. So you have different, elements of that. You have the fundamentals. You have the, um, maybe other models. Can you elaborate on what do you have? Like, do you have some mathematical models? Is it rigorous? Is it like is it a system? How do you assess objectively the risk? What kind of metrics do you have?
Yes, so definitely. Thanks for the question. The risk framework that we built is probably the most comprehensive risk framework for DeFi that's public in the world. It's really like we really push the envelope there. Um, it is a holistic framework in the sense that we look at all the risks that are possible, where you could lose your principal when you invest in a DeFi yield opportunity. It's as simple as that. The way that we do it is like we look at all the components of risk. And so when you invest in a pool, you have risk related to protocols, risk related to the asset itself, a little risk related to the chain. And so what we did, the first thing that we
Yes.
did was to have basically a scorecard for all the protocols, assets, and chains, the way that they're supposed to be. And so the way that they are supposed to be is basically saying what's the highest standard for DeFi. But DeFi needs to be decentralized. It needs to be like smart contracts that are not controlled by a person. That there is no backdoor behind it. That the contract has been battle tested, has been around, and is being used as like as something that's reliable. That like all of these checkpoints that the code has been audited by auditors that have a good track record. And so all of these things push us to have a very good scorecard where we are able to assess the risk on all the protocols in the same way. So it's very objective, it's fact based, and we do the same thing for assets. We do the same thing for chains, and we bring all of that together into a pool. A pool is basically a compounding of protocols, assets, and one chain. And we compound the risk around all of these components. So the part that is actually like super important is understanding that because of the composability of DeFi, you could have Yearn use a pool that is based on Curve, that is using an asset like Steed that is based on Lido. In a case like this, you have risk if Yearn has a problem, Curve has a problem, or Lido has a problem. And so what we do is like we have a full view of all of DeFi, we all the interconnections, and we are able to assess the risk around these interconnections as well.
Very interesting. That's very interesting. So about your risk models, how one question I'm curious: how have they performed historically? Are there any examples where things that, based on your models, were risky, they crashed, or they had problems, whereas the more sustainable ones um, did well?
Yeah, I mean, a lot of the cases of like crashes that we had seen around Luna or around Umami were actually in line with our risk framework. So we predicted that it was risky and it appeared to be risky. Uh, as a matter of fact, we also have a lot of cases where we predict it's risky and nothing happens. Like nothing bad
Yes.
happens. So, for example, like we had a lot of like with Frax, we had a lot of discussions with the protocol saying, "Hey, this is like risky in terms of like the stablecoin and so on." But like they ended up like improving over time, and it's an interesting case, for example, where we for us we would say like you need to get out of that pool or of that exposure as soon as possible. And in reality, like everybody until today has been fine.
Yes. So there is, I think, one thing that we've seen in the past in DeFi is the general perception is very important. So once everybody says this is risky, that's what we saw with Luna, that's what we saw with FTX, then people realize, oh, actually, there is not only risky, but things are starting to happen. Then it can go very fast. But until then, and that's maybe actually one of the concerns with Ethena. Until then, things can go actually up and can grow dramatically in TVL, in any kind of metric, in user adoption. So that's a good phase, right? And your role as risk management managers is to see, okay, what could happen eventually afterwards. So you mentioned that there are like already like more than 500 yield opportunities, but you only provide like kind of 25, right? So does that mean that you first do a first assessment of these pools based on your risk models, and then you remove like most of them, and so you have only 25 that you have whitelisted on your platform, and then the users are free on your platform. And then for these 25 you provide extensive and detailed analysis about the risk that they have, and then users are free to choose whichever of these 25 that they want. Is that how it works?
Yeah, the way that we do it is like we look at all the opportunities that are out there, and we do that on a weekly basis. Every week we look into new opportunities, and we see that we want opportunities that make sense. So if it does not make sense, if it's like pretending to be decentralized, it's not decentralized, that's out. We look into the yield, then we verify the yield, we don't trust it. And so it takes us like a good week to also like understand how the yield works compared to the advertised yield on the protocol. How the yield is it? Then we also go into like the whole risk assessment. If it's a new protocol or if it's a new pool, in any case, we are going to like look into like all the components of risk there, to put it in the map and to assess the risk well. Once we do all of that, we also look into the routes. How easy is it to get in, but also to get out? And so if sometimes you end up with like one-way streets, like and so we avoid those as well, because then like when something happens, you're not able to take out your funds, and that's really painful for most investors. And so once we do all of this due diligence, in a sense, we bring it up on our website for anyone to look at it. And so you will see it, one of the 500 DeFi yield opportunities that are out there. We test it as well with a few users to see their appetite, and if like it comes nicely in the framework of like the type of yield that we make available, we add it so that like it complements all the other opportunities.
So right now, as a benchmark, we have like few kind of safe yields, which is like Lido and and Rocket Pool and this kind of LSCs, which are around 3-4% per year. Then we have like some stablecoin yields, like SDAI, saving DAI from Spark, and Aave, etc. They have also there's this Curve USD and these kind of stablecoin yields, which vary but are around maybe 6-7% for the more sustainable ones. What is the highest yield that you among these 25 pools that you have right now? What is the highest yield?
Yeah, so the yield on Exponential is around between 4% and 25%. Most of the yield is around
Okay.
double digit, 10 to 15%. I think that's a very attractive yield for investors who are ready to hold crypto over time, but don't want to take too much risk. And so that's basically the profile of the investors that we have seen on Exponential. If you look at the yield, there is most of the time a double digit yield on stablecoins. That's like a pretty large one, which is like mostly done through lending, because people want to get leverage
Yes.
right now. And so it's a very interesting job to do over collateralized lending for people who want to take leverage, because there is little risk in principle by having over collateralized lending. Um, the other type of risk of opportunities that you have is around Ethereum. A lot of opportunities around Ethereum, from staking, lending, bridging, market making, like a lot of types of yield there. And we see very interesting yield around 20% on market making, for example, between ETH and STEET on, or between ETH and ETH plus on Yearn. And so we make those available, and that's a big point. The one new thing that is happening right now is around Bitcoin. There is more and more Bitcoin layer twos happening. There's a lot of demand
Yes.
for Bitcoin yield. And so that's very exciting. It's also coming with like obviously risks, because like the two big types of bitcoins that you have that can do this job are TBTC and WBTC. TBTC is decentralized.
Hmm.
WBTC is based on
Yes.
BitGo custody. And so the question also is like, so you end up having a little bit of risk related to these two types of bitcoins, but like the yield is it's also like Bitcoin being almost a deflationary asset. Is typically having very low yield. And so you see a lot of demand for Bitcoin, 2% Bitcoin yield. We have 5% Bitcoin yield, which is like very attractive, thanks to a protocol called Across that is doing bridging across layer twos. And so with the canonical bridging, which is like much less risky than bridging without that.
So you mentioned 10 to 15% on average on your pools. And on the other side, you mentioned that those yields that we are seeing on Ethena and LRTs, like plus 50%, are not sustainable. In your opinion, and how high could a sustainable DeFi yield be and still be within a framework of, being very healthy in terms of risk models? How high can we go? Considering the restaking, which is a new paradigm, which is interesting because you're not only getting yield from Ethereum, but you're validating another network, which is also providing you incentives. So if that network is trustworthy and the slashing conditions are clear, and the ABSs and all these things are good protocols, then it's not, we can't really say is that unsustainable. So maybe you get a few percentage there, a few percentage there. How high can sustainable DeFi yields be in your opinion?
So it depends on the timeline, time horizon. If you're looking at yield that is sustainable 4 years ago in DeFi summer, 45% was actually sustainable on Curve. You could make 45% yield. But it was sustainable for a year or two or three. And then like when the activity in DeFi decreased with the bear market, you saw more of just like 10% yield. Today we see it again a little bit higher than 10%. And that's because there is like more volume, more activity in DeFi. Tomorrow, in like 10 years, the yield is supposed to go down because the risk is basically
Yes.
going down, because there is like a theory of efficient markets at play, where more and more liquidity is going to come in order to do the jobs that are available now. Today, our perspective is that these yields that you see on Exponential are very much sustainable for the next 4 to 5 years. And so when we don't bring in a pool, if we don't think that that yield that you see is at least sustainable for a year. And so the way we look at it is it depends more on the asset than the job itself. Bitcoin yield around 5% makes sense. Ethereum yield around 10% makes sense. Stablecoin yield, if you have the treasuries at 5%, it makes sense to have it at 15% today. So these things make sense in that sense.
Let me ask you about real world assets. Recently, BlackRock announced they will launch a tokenized fund, and it's on Ethereum. We know how promising and real world assets could be. Many are talking about trillion assets, trillion in market caps coming to crypto. And we know that, for example, very established protocols like Maker are already, putting a lot of effort into that, and they are part of the yield that they're proposing is coming from T-bills and real-world assets. There are some real-world assets projects like LandX, for example, that I know that are giving you the yield from agriculture, and wheat and all these kind of things that exist in real world and bringing it on chain. Are you having a look into those from Exponential, or do you find them promising in terms of yield from real world assets coming to DeFi?
We look at these, but we don't rate them well usually. We see risk there. The reason that we see risk in real world asset yield is very simple. It's at the opposite of what DeFi is supposed to be. If it is decentralized, it is going to live on the metaverse. If you have real world asset or real world yield coming in, it means that there is a centralized party somewhere doing the bridge between the real world and the metaverse or the DeFi world. And so when you
Mm-hmm.
do that, you have to assess a new type of risk, which is counterparty risk. It is the counterparty risk is the risk that exists in CeFi everywhere, like in centralized finance, in traditional finance. It's all about counterparty risk. You have to know who you're dealing with, if they have enough money to pay you back. It's very hard to do that in the world of DeFi because there is something that's not happening on the chain. And so for us to assess a risk that is not on the chain, not transparent, not verifiable, not easily verifiable, we are going to put a lot of points on that. And so typically,
Yes.
like for example, if there is a stable coin using treasuries, well, we would want to see audits about the reserves on a preferably daily basis if not, then on a quarterly basis. And we would want to have a background check on people who have access to these treasuries so that they don't sell the funds and go living on an island for the rest of their life with a lot of money. And so we don't like to see this mix of DeFi and CeFi. We think that when there is centralization inside a framework of DeFi, it's DeCeFi, it's deceiving. Whereas, like when what we are doing, for example, is centralization using DeFi, C DeFi, that's much more sustainable and in a better framework.
Interesting. So DCFi is not okay, but CDFi is better. So I think it's a
CDFI has
valid point.
clear transparency.
Yes, I think it's a valid point because in the
Sorry.
we remember in the bear market in 2022, one of the everybody was worried about Circle and USDT Tether going down because they were saying, okay, what is like Tether? What is it backed by? We cannot verify, and they have invested in real estate, and in this real estate is down, so they're in a bad situation. And absolutely, this is something that we cannot verify, and the real world assets have this issue of off chain, off chain elements that is hard to trust and hard to verify. So let's jump from the real world assets to the AI sector. Uh, there are so AI is trendy, as you know, and crypto AI is also very trendy. There are a number of projects right now, like I'm thinking about Mosaic. I don't know if you've heard about them. There is also OneClick, who are who are DeFi protocols using AI to for yield optimization strategies and liquidity optimization strategies, kind of automated for the users so that they can they can just benefit, and the AI models can use these opportunities. And I think it's a valid use case of AI because these are kind of tasks that AI are good at, these kind of optimizations. Are you following that sector? Are you what kind of do you find this AI sector in yield promising? And also, as an expert in risk assessment, do you see any related risks?
I do not follow the sector, to be honest.
Okay,
Uh, I'm not able to speak about it well. I think is it AI or is it humans? It doesn't really matter because you end up having to have like decisions made on asset allocations, for example, on what type of instruments you're having and so on. I, I I'm not sure that that works, and so I I think it's very hard to assess the risk on these things um, because you end up having to trust someone to do the right thing. And if it becomes an enterprise, whereas like the smart contract are supposed to be something that doesn't change over time, that is doing the same thing, is doing it for everybody and at the same way. And so that type of yield is very different. I think the yield that is related to AI or humans actually doing things and making decisions is not the same type of yield. It's actually more about performance than yield. When we think about yield, it's something that's actually super clean, that is doing a very simple job, and that is like getting a return for providing that liquidity.
great. Let's zoom out from yield. Let's talk about the bear market. You actually raised 14 millions from Paradigm in the middle of the bear market where nobody was raising any money and VCs were not investing. So that's a huge success, doing that and launching at that time. Any comments on that, and how it went, and launching
Yeah.
at that time with all the challenges that we had? It was just shortly after FTX, or there around that time.
Well, it was announced then, but like I would say, we came with a vision that is very much in line with what was needed. Most people see DeFi as a really new asset class. It's a new asset class that have all the good fundamentals to disrupt traditional finance. The idea behind DeFi is that we're doing something that is more productive as humans because we replace work that is being done by bankers with contracts. And so it's the same revolution as AI that replace employees, or robotics that replace people on a supply chain. You have something that's really like amazing, where blockchains and crypto is replacing bankers in a sense. And so in that sense, it is sustainable. The issue was that it's not accessible. And so when we came together with like my two other co-founders, Driss and Greg, having all the background that we needed to build this, and it's very hard to build exponential. We it was really clear that it was something that was needed for the sector, in terms of education, in terms of also like just making it accessible, and so it was not that hard to raise.
Amazing. So that's a congrats on this achievement, because I remember at that time there was so much fear and all the data was showing VCs are not investing, and investing an investment from paradigm alone is a very big achievement. What is on your
I have
roadmap for?
to, yeah, I have to say that like the investors that were there are investors that know crypto. They know it's the fact that there are cycles, and they also believe in the fundamentals of it. And so yeah, bravo to them.
Yes. So tell us about your roadmap. What do you have for this year, next year? What are you building?
So the way that we're looking into this is like first we built the risk framework, then we built the ability to invest. We want to bring in more ways to make this easy for more people. So right now we are in 90 countries and 20 states in the US. We want to expand that, so we will have to get more money transmission licenses. Uh, so far, you would be only able to invest with USDC. We are adding more forms like Ethereum this month, Bitcoin the following month, USDT, DAI, and other stablecoins, and all types of assets. So this is going to take us like probably the rest of the summer. Uh, we are also like working into infrastructure as a service. We are a very specific place where you have information about all these pools, all these data points about the risk rating, all this yield that is verified. And so we have a lot of demand from like other fintechs that want to make DeFi more accessible as well, but like need all those data points that we have. And so there is like an opportunity for us to help the sector by bringing that transparency and that work of research that we have done out there. And so that's basically what's in stock for 2024 for us.
Yes, I think one of the elements of CDFI is because you have to go through the route of regulation. It takes a lot of time, right? It's you have to. Every country is
Yes.
different. Every legislation is different, and then every action that you take. Okay, should we allow USDC deposits now? USDT, if it's just a smart contract, you just add the code. It's done in one day. But if it's through a regulation, then it takes time. But we just recently saw the SEC going for Uniswap and suing them. It shows that if you go through the longer route of going with regulation, then yes, it takes more time. Yes, the adoption will not be as fast, the TVL will not grow as fast, etc. But on the other side, you feel safe. For you don't have to worry about waking up tomorrow and then saying, oh, actually we are being sued by SEC, which I think makes it really hard to build long term. So it's great to see actors like you building CDFI, as you say, and going with the regulations and everything, because this is one of the ways that the industry can, I think, prevail. Let's finalize with a hot take. We always do that. Talking about yields, we mentioned that yields are gonna go down with time, with as the industry get more established, etc. Many are saying that the staking yields on Ethereum are gonna go down to 1 or 2%. In your opinion, what will be the primary source of yield in the next 2 or 3 years?
So DeFi is currently in a Cambrian explosion where there is more and more layer twos, there's more and more protocols. There is like this phase where there is a lot of innovation being built. And all that innovation can only work with the capital to provide liquidity for these protocols. And so there will always be, and for a good time, demand for that capital. And while we are at this phase. And so we think that for the next probably 5 to 10 years, we are going to continue to have good yield opportunities for people who do the research to assess where to put it. And that's why we're very excited about the future.
Amazing. Thanks a lot, Mehdi, for this conversation. It was very insightful, and I wish you all the best for Exponential and what you're building.
Thank you, Koryo. It was a pleasure.
Thanks.
Talk soon.